the LTNC 2024 full year annual report. Okay. LTNC is Labor Smart Inc. It's a distribution company now. It was once, for people who didn't know, it was a labor company to start, like temp jobs, labor jobs 5 years ago. Turned into a beverage company. And now, while we still have Lockd'in as part of the beverage brand, we are now a distribution company with Illumination, with Legacy, and with Brad Wyatt as a CEO. I'm not going to talk about a whole lot about the story leading up to this annual report, because I've talked about that at length already in multiple videos. But I guess to bring everybody up full circle, a couple months ago, Tom Zara was our CEO, who got us pink and, got us through the last 2 years of Lockd'in next gen beverages. Finally, we linked up with Illumination Legacy, which we got Illumination Holdings, Legacy Distribution Holdings. We got Brad Wyatt, we got Scott and Sam along with that partnership deal. And so within that transition, we transitioned from specifically a beverage company with Lockd'in, Hydrogen Water, the Nootropics and such. And now with a lot of the different changes, we transformed into a distribution company, which means is while we still own next gen beverages Lockd'in, and we picked up Go Fast energy drinks as singular beverage brands that Labor Smart Inc. holds under its ticker, which the ticker symbol will be changing at some point in the future. That a PR came out about that maybe a month or so ago. Now we have a network of distribution facilities, right? So we have Illumination Legacy, which we understood from Q3 2024 from PRs. Now we acquired Krager Distribution, which is also in Colorado. And we'll talk about them a little bit as well. And just going off that first, I want to say, I mean, with all the negatives around the stock and, the past management and such, there could be a lot could be said, right? A lot could be said about how things were managed, how things were communicated to shareholders, and what was deception to shareholders. All those things can be said, and I think those are all valid things. Again, I've talked about those at length a lot on Twitter and other videos, but I want to bring up, I guess, the basis of how we get out of our situation if you're a long-term shareholder. And I think when you look at it holistically, the decision to not just be a beverage company anymore and to grow wider into a distribution company was the best option for all shareholders involved. And, that is me speaking objectively. If LTNC was still just specifically Lockd'in, we'd be in trouble. I think history has shown that it's taken a lot more capital, a lot more effort, especially the last couple of years, to get sales to even fund a business when you're just speaking of Lockd'in next gen beverages and their product lines. And so a lot could be said on the management of this whole situation. But the one thing that I give credit to Tom, the board of directors, or whoever really made the decision is to find a safe harbor within a business that, it might not be, quote unquote, recession proof, but it's something that we could survive with as shareholders. And transitioning over to a distribution company was the smartest move that we could have made. And before I really get into the numbers, I want to bring up why. Okay. So as a distribution company, our job is not just to distribute the products of, Lockd'in or GoFast that we own. We have a collection of other companies' products that we distribute to the local retail locations, gas stations, grocery stores, or anywhere else that needs a lot more product. And so a distribution company is a middleman between the manufacturer and the client, the end location, which is, say, a grocery store. And so, for an example of that, so say if Coca-Cola, and well, I don't think Coca-Cola is a good example because they have their own bottlers, which is like their own distribution. So, say another beverage company out there, right? They need their product in stores, but they might not have a sales team or a team to middleman that parlay into a retail because they're just focused on manufacturing, right? And so a distribution company comes in and says, "Hey, we'll buy your product at a wholesale rate, at a low rate. We'll hold it on inventory. We'll get it out of your factory that you made, right? We'll hold it in our inventory, and then we'll get it to retailers, other clients. We'll transport the inventory, we'll store the inventory, and we'll make sure we'll get it to that grocery store. And we'll sell those beverages or whatever product at a higher rate than what we bought it at wholesale from you. And with that, we scrape off the top and we scrape off the top of the difference of what it costs to buy and what we're selling it at. We have also royalty fees and such. So when you talk about a business, everybody is always going to be drinking something or consuming something. And we don't just distribute beverages, we could do snacks as well. And so whatever world we're in, people are still going to be eating and consuming stuff. And so when you talk about survivability of a company, this was the best thing for Labor Smart Inc. to do. You don't do it. You don't die on the sword of Lockd'in because it already has shown that it's struggling to get up. But what you do is you get hitched onto a wagon or onto a vehicle that can withstand a lot more of the ups and downs of sales. Because say if one company's product is not selling that we are distributing, I'm sure there's 20 other companies that we are distributing that will still bring in the revenue for our company. And so again, a lot could be said on how things have been handled in the past, especially the last 4 years. But the two major things I will give the company in 2024 is one, getting us pink, getting us back tradable, and two, making us a distribution company instead of a solely beverage company. And so on those two things, I think at least there's a basis of survivability and we can build on top of. And so now let's actually get into the numbers here. All right. One of the things that has been talked about a lot is our shares outstanding. So we have 25 billion shares authorized under our ticker. So that means is even if they're not on the float or not outstanding right now, we can get up to 25 billion. Right now, we're sitting at 17.5 billion shares outstanding. And it's gone up about 2 billion since being pink current, or 2.5 billion since being current. Where does that come from? Well, we had to pay for the acquisition of Illumination Legacy, which came with Brad, Scott, and Sam. A little bit of the history. Obviously, they tried to get their operation up and running in Canada. They fell some hard times with Canadian regulations. Obviously, with being a distribution company, is high capital, high investment. It just flat out didn't work. Now, when you look at why LTNC was attractive for Brad and Scott to come back to America and redo this is we already had 25 billion shares authorized. You know, we were pink current, we were already tradable. We got ourselves tradable to be at least attractive as a shell, And three, you know, there's a passionate investor base already to hold up the stock. And a lot of us are bagged at higher levels. So we're really not selling. And so it gives Brad and Scott a lot of leeway to work with, right? And so that's what I think made LTNC a very attractable shell. And so right now we have shares outstanding 17.5 billion. I personally believe they're probably going to max out or get close to maxing out the 25 billion if they deem necessary. Hopefully they don't do that for a while. You know, it took 400 million shares to get Krager. Which we'll get into the revenue numbers that might see on the cheaper side if they can get it more efficient and such. And with that, we have the shareholder equity of 10.8 million. And so just doing some calculations on book value. So what book value is you take the shareholder equity divided by the shares outstanding, and that's what gets your book value. And even with that, there still comes with different what I should say, different perspectives on what a book value is. And so I gave 3 different variations of how to look at book value. And for me, as a value investor, I like to look at book value in all my companies just to say, okay, in the case of liquidation, how much is this company worth and where's that stock price at in a case of liquidation? And so the reported book value from management, and I have to also throw up, I think on Friday we closed at 001. So we're literally one tick away from being a trip stock, and we did close at 0009 for 1 day last week, which effectively broke my bottom call because I didn't think we would drop below 001. But even if it was for a day, my bottom call was washed out. But when looking at value from management and how I see it from what they reported, so if the shareholder equity is 10.8 divided by 17.5 billion, I have a book value of 0006. So we're a mids trips company based on what they are saying we have in regards to assets and liabilities. Okay. A realistic book value, because you have to understand when you're really going into the financials, and I don't have it screenshotted here, but you'll see they have investment in Krager, investment in Illumination, investment in GoFast, all under the assets portion of the filings. Now, you can say technically that's not wrong for them to do because yeah, that was an investment. But I think when you look at that, I consider it more of that of an expense than an actual asset, because you investing 25 million in Illumination, you investing a certain amount in an operation doesn't mean it's actually worth that. And I still believe they are over reporting the investments in like Illumination. They're saying it's 25 million investment. You might believe, you know, you have 25 million in, you know, assets, money and such. But I don't think it's directly, you know, I guess being it's not directly impacting the company as you would see, right? It's not actually $25 million in the bank as an asset, right? And that's why I essentially cut a lot of that in half to where I would say the realistic book value is 0003, which is about half of what they're reporting. And that's just me being conservative. You know, that's not me being bearish or anything along those lines. I just have to look at it at a conservative view to see where are things at. And so for myself, if we were to be liquidated today, which I don't think that's happening, I would say, 0003 for the stock. Now, the last one, which is more in line of how I would look at it, investment, because you have to consider growth. You have to consider a lot of things outside of book value, growth moving into the future. What's the goodwill of the company? What's the shareholder base like holding up the stock price, and such. So with the fair value I have, with the 2025 growth that I see, we're kind of in line. We're already trading at, it's a 0011 company. I think we're just a 001 company, which we're trading at now. And I think that's fair and reasonable because it considers what we have on book value, but it considers that, we'll be growing some, and, we have some forward progress to go, because when you're investing in the stock market, it's forward looking. Okay. And so even though I have reported book value in the low trips, or I have in the mid trips, realistic book value in the low trips, I think fair value as a company is a 001. And so I think, we're right where we need to be in that sense. When you're looking at the numbers, so Krager, so if you go back when they announced the Illumination and Legacy deal, they said, they'll boost the revenue up by 25 million. That didn't happen. They put it on it as an investment on the books when it actually came to be, which I talked about in the past. That's not what the PR said. But with Krager, the Krager acquisition was what everyone thought Illumination Legacy was going to be. Okay. And so just looking here, just from a PR we had when it dropped, Labor Smart Inc. has announced the acquisition of Krager Mercantile Co., a Denver-based wholesale distributor that generated $22 million in revenue in 2024. The acquisition completed through the issuance of 400 million restricted common shares for 100% ownership, with the deal retroactively dated to November 1st, 2024, which means is we got 2/3 of the revenue for Q4 from Krager being backdated. And when this news came out, I said, and the bar's low, but I said, as long as the filings show the back date of November 1st for Krager's revenue, I will be at least okay for now. Because if you look at the previous earnings reports, the story was not aligned with what we were being told. And so this was the first report. I feel like, for the most part, it was all reported correctly and the story was lining up. And so this is why, okay? And this is when we start getting into the numbers. First, so look, so we'll go here first. So this was the year to date for Q1 through 3, 2024, right? This is before this might have been before. This is definitely before the Krager deal, because this was September 30th, and then we had October, which was only next gen Lockd'in what we had, right? And so from all the way up to September, to 9 months, we had $850,000 in sales. Okay, that's what LTNC did before Krager, with adding Illumination to the mix, but they're not really generating a whole lot of revenue. They generated minuscule revenue, which was a whole ordeal. So we got 850,000 up to that date, right? And so let's look at what we did for Q4 with Krager retroactively added to November and December, and what we did in October for next gen. And so what we did for the 3-month period ended in 2024, we did almost $3.4 million in sales. Okay. And for the year ended, that meant we did $4.2 million in sales in total. So in the 3-month period for Q4, we did $3.4 million. And now, to be frank, I'm sure not a lot of that came from Next Gen, Lockd'in, and Go Fast Illumination, right? It had to come from Krager, right? Because it was backdated November 1st. And so I did some math, right? And so I came up with round about 65% of the revenue in Q4 came from Krager Mercantile. And so I thought I was pretty generous on giving Next Gen, Legacy, and all that before Krager about $1.2 million in sales for the whole year, right? And so divide that by what we did is about 35%. All right. In total sales. It was about 35% in total sales. So 65% Krager, 35% total Gen. And that was most of that coming from Q4. And so what I did after that is I took what Krager did and I divided that by 2. And so I came with about 1.1 million per month in November and December. So that's what they added to our sales. Okay. And so spanning that out, obviously that doesn't, linearly that doesn't come out to be $22 million revenue, but there's a lot of things that go into that. Maybe, we cut a lot of brands from November and December, which cut the revenues, but also cut the expenses as well. So those are things to think about. But the biggest thing is, in only 2 months of having Krager, they generated 65% of our revenues, which in the past, I mean, that has to be seen as a positive because we weren't generating enough beforehand. And so another big thing people were talking about were the expenses. They look at the expenses and they see, well, the cost of sales are really high. We sold to 4.2 million, but it's costing it's costing almost, it's costing 4.2 million in cost. So we had the year end, we had a gross profit of $40,000, which isn't anything to write a home about. But I think people have to understand is when you're acquiring new companies, when you're trying to adjust things, it costs to do that. So when buying Krager, the reason why we got it at 400 million shares is probably because it wasn't operating really efficiently. It was bringing 22 million in, but it was probably costing close to 22 million out the door. And so when you're combining them together, Legacy, Illumination, and Krager, you're getting all the different network waves together. It should cost less. If you're running a good business, it should cost less over time. And so moving forward in the next couple quarters, we should be seeing the cost of sales going down, hopefully. But for so much change happening in Q4, in my opinion, the cost of sales is actually right in line. And now let's look at the expenses. And the main expenses I want to look at are payroll, benefits, selling, and general administration, right? And so, and up before we got Krager in Q4, the payroll and selling and such, it was about I would say, about 1 million, right? Close to 1 million before. And then, so let's go into what happened in Q4. Again, it's about 1.1 million. So, it really was not, over the top cost expenses wise, in my opinion. Yes, some things were raised, obviously, because we had Krager, more people on the board and such, but more businesses, trucks and stuff. But it wasn't anything out of the ordinary. And for the year ended, it essentially doubled. So when you look at what happened, our expenses doubled, but we got a significantly more revenue generation from it. And so if this all works out, at least from the Krager's point of view, I think the 400 million shares that we had to cough up to get 100% ownership, if they can keep the profitable clients and they can work on the efficiency and cut costs down, I think it will eventually work out over time. You know, the reason why is such a capital intensive business is because you have to buy the inventory, you have to have the equipment before you can even really get going in sales and such. And so the estimated payroll and selling benefits in 2025, you know, if it's going to cost 1.5 million per quarter, which I kind of see, right? And so we have about 1.2 million here, right here for December 2024. And so I'm giving it an increase. I'm giving it almost like a 25% increase for 2025 at 1.5 million over four quarters at 6 million in expenses. All right. And that's just in payroll and selling and G&A, which for the most part is the most of it. You know, that's the people. That's the daily operations type of thing. So we have 6 million here. And so say if we do get Krager Mercantile and we get their 22 million in revenue, and you give them a 10% increase in revenue growth for 2025, so that's 24.2 million. And so say expenses all in for the year, all right, it's going to cost, you know, let's say 10 million. You take the 6 million from benefits, selling and G&A, and you take all the other expenses, say that's 4 million. That's 10 million for the full year 2025. And we have revenue, and we're just talking about Krager here, and we have revenue growth to 24.2 million. So there is, you know, a 14 million difference, right, of operational income. Obviously, there's other things that come into play, but off the bat, to me, I do believe the economics of the distribution company, they make sense as long as they're doing the typical business things. You're cutting expenses, you're generating more revenue, and you're playing things smart. And so, you know, overall, you know, I'm not saying I'm, you know, happy, elated about what has transpired in the past for LTNC, but I can see a way out at least. If Brad and Scott can do what they need to do with Krager, Illumination, and Legacy, the economics work, right? The expenses should not scale the same as the revenue. Okay. And that's not accounting for what Lockd'in and Go Fast can do. Right. I'm actually taking them out of the equation. They're still a gamble and a crapshoot. So I can't rely on whatever revenue they generate in. I can only go off of what I see that we're already bringing in. And, you know, Krager is hopefully bringing in about 20 plus million again this year. And so I'm only going off what I can predict. And so in regards to some gematria, I have high capital investments take longer to produce profits for growing businesses, which is 333 in English reduction. And I have Krager helping LTNC's revenue, which equals 133 in reduction and 137 reverse reduction, which is the 33rd prime. And Krager Legacy Illumination LTNC equals 137 in reduction, the 33rd prime. And so those are some pretty cool numbers. And you know, I don't have a whole lot, like there isn't a whole lot to talk about to go in because we're really starting right at the beginning again. LTNC is at the beginning stages of what it should be as a distribution brand company that has two brands that can take their growth to the next level. And my still holding my shares. I have 2,222,022 shares, about $20,000, and I'm down 89%, obviously, and I'm still holding. And so I do believe, you asked me, is the company in a better position than they were since going pink? Absolutely. Absolutely. Even though we got pink, we had no real revenue generation source. The reason why our revenues were so high in 2024, especially in Q2 and Q3, was because of shareholder product buys of getting pink, the elation. But when you look at the this revenue numbers after that point, they started to dip again. So that was a clear sign that we needed to do something different, because the hydrogen water and different products were not going to do that. And so now I'm more comfortable in investing in this as a distribution company than as a beverage company. So we're not out of the woods yet. There's still a lot to go and prove to see if this actually works. But I think we're at least in a little bit better of a spot. So that's what I have on LTNC today. I just wanted to give my thoughts, give a couple of the numbers and such. What we need to look out moving forward is Krager really generating the 22 million that they said they did in 2024? That needs to be able to scale out, and I need to see that in quarters moving forward. Are they cutting costs? Are costs going down? And is Next Gen and Go Fast, are they adding anything to the pot? So those are the things I'm going to be looking for moving forward.